This is John Graves, editor of TheRetirementJournal.com and author of The 7% Solution. You can afford a comfortable retirement. Today we're talking about basic life insurance. The purpose of life insurance is to help you to manage risk. In the case of life insurance itself, you're managing the risk of the loss of the economic entity represented by your business partner or by your spouse. You identify that economic value and insure against that risk. The manner in which you do so is typically with either term insurance or permanent insurance. Term insurance is, as the name implies, insured for a period of time, 1 year to 25 or 30 years. The cost for that insurance is typically fixed for the term, and the death benefit, the coverage amount, is also typically fixed for that term. Permanent insurance, on the other hand, is just that. The insurance is ongoing until someone passes away. The cost is structured quite a bit differently, and the mechanics of the policy itself can be extremely complex. Permanent insurance typically costs quite a bit more, and it is designed to have, in addition to a death benefit, a living benefit. In fact, it is a savings account or an investment account. In terms of the basics of insurance, once you identify a need, typically with an insurance agent or possibly online, you then fill out an application. You typically have a paramed visit, and she takes a blood and urine sample, asks a few basic health questions with regards to your health, your attitudes towards a healthy lifestyle, and the health of members of your family. That information, along with what's called an APS, an attending physician's statement, is then forwarded on to the underwriting department of the life insurance company. And in underwriting department, they will analyze the information that you provided for them and determine the level of risk or lack of risk that your health and your life and your age and your attitude represents. If they feel that you fit into their risk characteristics, they will then offer you a contract at a set price. The agent will deliver that contract to you, and upon review of it, you will then accept it, sign it, and begin paying the premiums. Typically, you want to pay those premiums once a year rather than once a month. It is less costly in that manner. With regards to permanent insurance, again, it has a savings component to it. Quite frankly, a living benefit in addition to the death benefit. With permanent insurance, you have to be able to not only afford the contract, but you really want to be able to fill this contract up with as much money as possible. There's a Internal Revenue Code limitation called the maximum non-MEC limit. MEC is modified endowment contract. And your insurance agent will tell you on a permanent insurance contract what that number is. If you're going to use permanent insurance, you want to be able to fill that contract up each year with as much money as possible. If you do so, it will work to your advantage. It will provide you significant living benefits in terms of disability or retirement needs. If you don't, the insurance company and the insurance agent will make money. You will not. In a brief sidelight, insurance agents do quite well. They typically earn between 60 and 105% of the first year's premium. If a typical insurance agent sells 10 or 12 contracts a year, whose premium is $15,000, you can see how well we do. Thank you. This has been John Graves.